Shares of Nvidia have been on fire over the past couple of years as artificial intelligence has become something that is just a growth phenomenon. Shares are up over 200% in the past year, and Nvidia is now one of the most valuable companies in the world, if not the most valuable company, depending on when you're watching this. But I think there's 5 reasons the company is going to come back to earth in 2025, and we're starting to see signs that this is already happening. Growth is starting to slow. Growth's not going negative, but the rate of growth is slowing. Margins are coming under pressure, and competitors have seen Nvidia's success and they are coming after the company. So those are just a few of the things I'm going to go through today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. First of all, I want to put Nvidia's growth into context because these numbers are astounding. These are the trailing 12-month revenue and growth numbers for Nvidia. You can see that revenue growth was negative as recently as late in 2022. That changed in 2023 after ChatGPT came out. Growth was in excess of 200%, but you can see that those numbers are starting to slow. Now, 122% growth is still an incredible number, but the pace of growth is likely to slow later in 2024 and then into 2025. When that pace of growth slows, then investors start wondering, what should you be paying for a company like this? Is it appropriate to pay 40 times sales for a company that's not growing 100% a year? Maybe it's growing 30 or 40% a year. So I think as that growth rate slows, the narrative starts to change in the market. And that's one thing that can drive a stock lower. The second thing to look at is margins. Margins for Nvidia have been absolutely astronomical, but I do want to put them into context. This is a chart that shows their long-term gross margin in green and their operating margin in blue. So historically, you have a gross margin that's between 55 and 65%, and an operating margin that in the best years is going to be between 25 and 35%. But what does that look like recently? Look at these gross margins over the past year: 78.4% in the second quarter, 64.9% operating margin. Now they're going to have operating leverage because they now have far more sales than they've ever had. They're not increasing their operating costs, things like R&D, sales and marketing, at nearly a commensurate rate to the rate that they're increasing revenue and gross profit. But an operating margin doubling over the past 2 years is probably not going to be sustainable, and we're already seeing signs in the most recent quarter that gross margin and operating margin are starting to come down. Again, as those trends start to go lower, the market starts to reconsider what should we be paying for this stock. The other thing from a margin side is we know that Taiwan Semiconductor, who is the one who makes Nvidia's higher-end chips, particularly Blackwell, is starting to raise their prices. Those prices are going to be as much as 25% in 2025. And Taiwan Semiconductor itself has talked about this, but there's so much demand for artificial intelligence chips, especially the chips on wafer on substrate like Blackwell, that Morgan Stanley said that Nvidia has already seen price increases of 10 to 20%. Those are going to be coming down the pipeline. When those prices go up, that means your gross margin is going to come down. So this just feeds evidence into the fact that those gross margins are unsustainably high for Nvidia. And we haven't even seen price pressure yet, but that is going to be coming next year as well. And that price pressure is the third thing. The reason I think there's going to be a lot of price pressure is because a bunch of competitors are coming into the market. You have AMD as the biggest name, but then companies like Apple are making their own chips that are going to be doing inference on their own devices. That's maybe not a direct competitor, but it's going to take some of the inference that was done by Nvidia chips onto other chips. You have every one of Nvidia's biggest customers are developing their own chips. This is the thing that I think we're going to eventually look back on as being a point of concern. Nvidia is a company that doesn't sell products directly to end users. It sells products to big hyperscalers. So it sells chips to Meta, Microsoft, indirectly to OpenAI, who's using Azure, which is the Microsoft cloud, Amazon, and AWS. What do all 3 of those competitors have in common? They are trying to develop their own chips to do training and inference so that they're not reliant on Nvidia chips. Doesn't mean that they've been successful so far, but they've been at this for more than 2 years now. And Alphabet has shown the way because Alphabet's TPUs are gaining share in the marketplace. So there's at least one competitor out there for Nvidia. I think that is going to increase in 2025 as all of these companies try to build better and better artificial intelligence chips. They don't have to be better than Nvidia, but it may change the cost benefit. It may change what Nvidia is able to charge for their chips. Those are extremely high prices. That's why they have those high margins today. So that competition is going to come from the demand side and the customers that Nvidia is selling chips to, and they're doing everything they can to not be reliant on Nvidia long term. The fourth thing from the demand side is Nvidia is facing more and more pressure on what it's selling into China. This is a big market for Nvidia, not necessarily the high-end chips, but some of those lower end chips are going into the Chinese market, and the US government is restricting those more and more. That will likely increase, those restrictions will likely increase with the next administration coming in January. So that will reduce the addressable market for Nvidia because it won't be able to sell into China. China is not going to be the demand source that it has been for the last few years. There was a huge windfall from Nvidia for selling chips into China before some of these restrictions took place. That is not going to be a windfall they're going to see forever. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. And the final thing that ties all of this up is multiples. Multiple expansion has driven Nvidia stock over the past decade. Just check out this chart. Going back to 2015, the price to earnings multiple for Nvidia was under 20, and the price to sales multiple was hovering around 2 or 3 times. Now, that price to sales multiple is more than 10 times higher than that at 37 times sales. That's what this green line here is. Price to earnings multiple is still high at about 70 times, but I talked about that margin compression that may be coming. So that price to earnings multiple may be on artificially high earnings. So if those multiples compress, and they could compress really significantly, earnings could come down. The price to earnings multiple could also come down. But a price to sales is the one that I think you should keep an eye on. 37 times sales is an incredibly high price to sales multiple. And if that growth rate starts to turn over, it starts to go closer to 30, 40, 50%. That's still a high growth rate, but you don't want to be paying 30 times sales for a company that is this big and has competition coming from all sides. I think the slowing of revenue growth, the margin compression, competition, a smaller market because there's going to be restrictions on China sales. All of these things are going to eventually lead to multiple compression, and that's ultimately what's going to be the biggest driver of Nvidia stock underperforming the market in 2025. I think this could fall significantly, well over 50%, if all of these things play out. But we'll see how this goes for Nvidia. An incredible run for the company. Two things can be true. This can be a phenomenal company, and it can be a way overvalued company. Both of those things can both be true. But let me know what you think in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.